Hi everyone. So welcome to the live stream today. Very much excited for having you on the live stream as we continue with our discussion towards the ICA April 2022 exams. And I believe that your revision is going on well. And want to share with you some few key things as we try to bring home our revision session and discuss various things that we need to understand. So this is a Q&A session. So hit me up with any questions you have, anything that you have challenges in that you would want me to share my thought on. I'm going to be sharing my thought on it. So in the chat box for those of you who are watching on YouTube, and then in the comment section for those of you who are watching on Facebook or Twitter, you can join us and then give us a thumbs up on the video and comment with any questions that you have. Want to share with you also some smart revision strategies that you can implement right now or today in order for you to really prepare well for your examination. So welcome. I see some of you guys joining us on Facebook, on YouTube as well. Put in the chat any questions you have for me. Want to hear from you and also share some thought with you in that case. Okay, so Joseph Babs, I see you with a thumbs up in the chat. And then also Alhaji Jalo. So I see you also in the chat there. Thank you for joining us on the stream today. Okay, so as we prepare for the examination, there are a couple of things that you need to take into consideration that you need to know about. Most importantly, because of the fact that it appears that the April 2022 exams, I mean, the time looks a bit limited. But then I tell my students all the time that if you are ready and you are prepared for the exams, you can definitely write the exams and most importantly, pass the exam. So timing is not an issue. Now, by now, it means that you have decided that you're going to write the exams. Now, in case you're not going to write it, it's okay. You can go to August, and that is not a big deal there. But then if you're going to sit for the April 2022, today I want to share with you a couple of strategies that you can implement right now smartly so that you can do your revision. But like I said, this is a Q&A session. What are the challenges you have? What topics you have problem in? Maybe something you would want me to share my thought on. Put it in the chat, put it in the comments for me. I want to hear from you and then see what I can do there in that case. I see some chats coming in. Said Augustine said, hello, sir. Good evening. Good evening, Augustine. I hope you're doing well. Then we see Francis Kofi Ban with a thumbs up in the chat. Thank you, Francis. Alfred Gabagore. Forgive me if I don't mention your name right, okay? Alfred Gabagore is also saying hi. Hello, Alfred. Thanks for joining us on the live stream. Then we have Augustine said PEFA in PSA. What exactly about PEFA would you want me to share my thought on? Because what exactly on PEFA? The PEFA is a framework that we use to assess the effectiveness or the strength and weaknesses or the effectiveness and efficiency of the public financial management system of the government. So under the PEFA, there are 7 key pillars that we use to assess government financial public financial management system in place to find out whether it is efficient or not efficient. Under these 7 pillars, there are 31 dimensions under each of them. That not under each of them, there are 31 dimensions in total spread over the 7 pillars that we use to assess the government's public financial management system. We have the issue about budget reliability. We have issues about budget execution. We have issues about the asset management. We have issues about auditing and scrutiny. We have issues about reporting. All these are various pillars that are used in assessing the efficiency and effectiveness of the government's public financial management system. However, one of the things that you need to understand is that the way we assess the public financial management system of government, it depends on the rating rule. So there are 4 ratings that we use to assess whatever dimension or whatever indicator that we are assessing at the end of the day. It is A, B, C, D. That is it about that. A, B, C, D. So whether we are assessing budget reliability, we are assessing budget efficiency, we are assessing the budget outturn, we are assessing reporting, we are assessing transparency, we are assessing scrutiny, we are assessing cash and asset management, public debt management, whatever it is we are assessing, we are going to be grading it using the 4 key letters A, B, C, D. Now, the way the grading system works is that it is turned upside down at the end of the day, so that the higher the rating, the better it is for the country. What does that mean then? It means that even though it is A, B, C, D, we label it as A being number 4, um, BB number 3, CB number 2, and then DB number 1. So we turn it upside down in order to assess. Now, so what does that mean? It may now there are some guidelines relating to how it is done generally in practice. And let me see if I can bring my screen up to show you some issues, or to show you something there from my slide here about PEFA. Let's see if I can bring that up. Let me know. I see some of you guys joining. Give us a thumbs up on the video, and also comment with any questions you have for me. It's a Q&A session, so I want to hear from you guys. Let me see. PSA. Am I gonna? Let's see if I can see my slide on PEFA so that I can just throw it up. I have a beautiful slide here that will be able to assess that pretty well. Let's see. PSA. Okay, I see some comments coming in. Keep bringing them in. I'm going to read all of them for you. Yeah, I've seen my slide. I'm going to throw that on the screen in a moment so you see. Okay, so I believe you can see my slide now. So when it comes to the PEFA, what's happening here is that we have what we call the weakest link method and then the average method. You know, with the weakest link method, it is where what happens is that a positive indicator on one side, or a positive dimension, can net off a negative dimension from another dimension in the same indicator at the end of the day. But again, the rating are going to be the same for whatever we are measuring. But what happens is that if we have any dimension, we do the calculation. Now, there are calculations that are done for this. Let me explain the average method and I take you through some calculations real quick. So there is the weakest link, where we said that this method is used for multi-dimensional indicators where poor performance on one dimension is likely to undermine the impact of good performance on other dimension of the same indicator. So whatever indicator it is that you are measuring, maybe you are measuring budget reliability. When it comes to budget reliability, there are a number of dimensions under that. So one part could be positive, another part could be what? Negative at the end of the day. But we have what we call also the average method. The average method is where we look at the aggregate indicator score for the dimensions that we are measuring at the end of the day. So these are the two broad scoring method that we need to understand: the weakest link and then the average method. However, like I told you a moment ago, we're going to be doing our grading system using the 4 letters A, B, C, and D. So this is what it means here. This is what you need to understand broadly at the end of the day. So A means very good, excellent. B means it's better or good. C means it's average, and D means it's poor. So the way the scoring system works at the end of the day is that A means 4, B means 3, C means 2, and D means 1 at the end of the day. So that is the scoring system. So depending on whatever it is that the examiner gives us, then we would have to then do our calculation and make the judgment at the end of the day. So let me use a scenario here for you to explain what we're talking about. So look at this question here. This was what came last semester about the PEFA. So look at the question we have here. I want you to stay with me carefully so you get the interpretation. Now, I see some of you guys are just joining. Put in the chat for me any questions you have. It's a Q&A session. Someone asked a question about PEFA, that is Augustine, and that is what I'm answering. So put in the chat for me any questions you have, and I'm going to be providing you with some answers as we continue with our discussion. So look at this question here. Now, the examiner said M2. M2 means we are using the average method. M1 is the weakest link method. Okay. So he says we are looking at financial integrity. So we are assessing financial integrity. That is the indicator that's under the dimension that we are looking at here is bank account reconciliation, suspense accounts, advanced account, and then financial data integrity process. Now stay with me carefully on this one. You realize, look at the scoring there. Bank account reconciliation, it's D. If you remember the grading system, I told you D means 1. That is why you see I put 1 there. Suspense account is also D. You see I put 1 there. Advanced account is A, meaning that it's very good. So when it comes to advanced accounts, the loan account of government, it's done well. So that is A4. Then financial data integrity process, that is C, and that's going to be 2 at the end of the day. So when you add it up, that is going to give you an amount of 4 plus 2, 6, it become 8. 8 divided by 2, that is going to give you an amount of, 8 divided by 4. Let's see. So 1 plus 1 plus 4 plus 2, that is going to be 8 divided by 4. And that's going to be 2 at the end of the day. That is C. Okay, that is C. C means that it's an average performance at the end of the day. So that is the guiding principle on how we do the interpretation. That is the guiding principle. So you're going to, whatever the question is, the examiner is going to give you the grading. Other times, what the examiner will do is that he will provide you with maybe it's a budget out 10 question like this. So you have to know that. So this is an example of budget out 10, and we explained this in class. In our PSA class, we explained this in detail during our executive regime masterclass, and we'll be running through again next week as we continue with our discussion. But that is the idea about it. So if, for instance, you are looking at out 10, this is the guiding principle. So when you do the calculation in the exam hall, if the thing is less than 1% of the total budget of the government, that is A rating at the end of the day. So basically, when we talk about a PEFA, my key takeaway I want you to have is this one, the grading principle. Then aside having the grading principle, that is A, B, and C, and it being 10 upside down, you must also understand what kind of dimension are you measuring. Is it an out 10? Is it a budget reliability? Then whatever grading system you have, once your A, B, C, D is at the back of your mind, and the weakest link or the average method is also at the back of your mind, you will be able to produce an answer that will enable you to get the marks that they are supposed to get in that case. So basically, when we talk about PEFA, that is what we are talking about there. Let me know if that makes sense for you. And then if there are any other questions, please put it in the chat for me. Let's see, I get some other questions coming up. Joseph Jab said, exam will be in May in Nigeria. Okay. That's fine. Okay. ICA, we are starting. Now we have 3 examination dates. Bella Christopher said, hello, sir. Hi, Bella. Thanks for joining us. Salisu said, joining all the way from Nigeria. Okay, thanks for joining us on the stream today. Cost classification for ACCA. I just not understanding. Okay, what I would say is that maybe you can watch my video on the portal, on YouTube under cost classification. But generally, this is a key topic which is in management accounting, whether you are doing ICA, ACCA, or whatever it is. But cost classification simply has to do with the grouping of costs into various categories based on certain features. Broadly, we have classification of cost according to nature. Now, when we say classification of cost according to nature, it means classifying cost according to the elements of cost. Stay with me carefully. When we say classification of cost according to nature, it means classifying cost according to the elements of cost. Now, there are three elements of cost: material, labor, and overhead. So, under classification of cost according to nature, we have material cost, labor cost, and then expenses. Then we ask ourselves, what the heck is material cost? What the heck is labor cost? What the heck is expenses? So, material cost simply means the cost of the ingredients or inputs used in the production of goods and services. The cost of ingredients and inputs used in the production of goods and services. Then we have labor cost. Labor cost is also simply the cost of human effort or the amounts paid to labor for work, for the production or the activity being undertaken. Then expenses are all other costs incurred apart from material cost and then labor cost. Does that make sense? But then, still under material costs, labor costs, and expenses, we can divide that broadly into two again to talk about direct material cost and indirect material cost. So, what is the distinction between direct material and indirect? Direct material costs are costs that can be traced or allocated to a particular cost center or cost unit, whilst indirect material costs are costs that cannot be traced or allocated to a particular cost center or cost unit. That is one of the distinction. Two, the summation of all direct cost gives prime cost. So it means when we add direct material cost, direct labor cost, direct expenses, that gives us the prime cost. Whilst summation of all indirect cost gives us overheads. Okay, it gives us overheads. That is the second distinction between the two. The third thing is that when we deal with controllability, direct costs are more controllable and indirect costs are uncontrollable costs. Why? Because direct costs represent a greater percentage of the total cost, whilst indirect costs represent a lower percentage of the total cost at the end of the day. So that is the concept about classification of cost according to nature. Okay, according to nature. Then we have classification of cost according to behavior. Now, when we say classification of cost according to behavior, it means we are classifying cost according to how it varies with the output level or how the cost changes with the output level. What do we mean by that? It means that when we are dealing with classification of cost according to behavior, we are looking at fixed cost, variable cost, semi-fixed cost, semi-variable cost, and then, sorry, semi-fixed cost, and then step cost. You know already fixed costs are costs that remains the same irrespective of the output level. Variable costs are costs that varies with the output level. Semi-fixed costs or semi-variable costs are costs that contains both fixed components and variable components. And then step costs are costs, additional costs that are incurred when output exceeds a certain limit or output level of the organization. So that is also the concept about classification of costs according to behavior. But then that is where the high and low method will come in for you to use the high and low method to split the cost into its variable and fixed components when total cost is given at the end of the day. So, like I mentioned, Salisu, no, that was not Salisu. My dream, like I mentioned, the name of the person is My Dream. Like I mentioned, you can watch the full video of cost classification on our on the YouTube channel. You can check the management accounting playlist. There is cost classification there, and you can watch that video, and definitely you'll be able to understand it. But this is the summary of the topic as I just mentioned to you. Then we have classification of cost according to function. This is where you are classifying cost according to the department that actually incurs the cost at the end of the day. So we have classification of cost according to function. So that is also there in that case. Does that make sense? Okay, so let me know. I see some of you guys joining. Give us a thumbs up on the video when you join. It's a Q&A session. Drop your question in the chat. I'm going to be answering as many as I can on the live stream today. So drop your questions as fast as possible, and then let me look at it for you. Joseph Bab said, IPSAS 17 and IAS 16, are they the same? Yes. IPSAS 17 is the accounting standard for public sector organizations. So when you're in public sector accounting, you're going to be dealing with IPSAS 17 because that is for property, plants, and equipment. Then when you're in the private sector, you're going to be dealing with IAS 16 generally. So yes, they are the same. The rules apply the same. The only thing is that the group of assets in the private sector is going to be a little bit different because in the private sector you may be dealing with issues such as construction work in progress. You may be dealing with issues such as some infrastructure, property, plants, and equipment. So the terminologies are going to be a little bit different when it comes to the asset class in public sector, but really the principle are the same. The cost module is there, the revaluation model is there, straight line method is there, reducing balance method is there, revaluation of assets is there. Again, you have to understand that in the public sector, there is nothing like revaluation gain, revaluation loss, that kind of thing, because there is a way it is treated separately in the books of the governments, and we're not going to be having revaluation gain, revaluation loss, like how you would have treated in OCI when you are dealing with the private sector under IAS 16. The treatment in IPSA 17 is not going to be anything like that. So there is a slight distinction on some of the items, like the way we deal with revaluation surplus in the books. And there will not be anything like deferred tax also when there is a revaluation of assets in the public sector. Unlike private sector, when I deal with IAS 16, there may be revaluation of assets, and that will result into deferred tax as per IAS 12. So there is some slight distinction, but broadly, about 98%, the things are going to be the same at the end of the day. So Joseph, that is what you need to understand there. Let me know if that makes sense for you, Joseph. I see some of you guys joining. Welcome, and give us a thumbs up on the video. Please share the video. Let's reach many students on the stream. And also comment with any questions you have for me. Okay. Kwesi Yeboah said, Nhyira, I haven't seen you teach earning per share under FRO. Are you sure? Are you sure we've not treated earnings per share? I have not checked though, but probably we've taught earnings per share. I'm pretty sure on that. Yeah, we've taught earnings per share on the channel. You can check the channel, the accounting standard series. There should be about 100 and something videos there. Check the playlist. I think we've taught about that. If we've not taught it, definitely it's part of our main course on our portal that you can enroll in and get access to. Obed Asante said, Sir, please, I'm having difficulty learning. Okay, Obed, if you are still on the stream, what is the difficulty you are having? Let's be specific. Give me some specific, and let me provide you with some specific answers here. What's the difficulty you are having? Is it that you are not motivated to study? Or when you pick the book, you don't know where the heck you should start from? Or when you study, you forget? Or what's the issue, Obed? So if you are still on the live stream, Obed, give me some specifics. Let me know what really is the difficulty you are having. Give me some specific, and then probably I can provide you with some contextualized answers that will help you better. Gianna Coppola said, okay, I don't know. Kwekudi said, hello, Nhyira. Kindly drop your contacts. Okay, you can WhatsApp at 050-114-9296. You can see the number below the screen, but I'm going to see if I can drop it here as well. Let's see if I can drop it. 050-114-9296. Okay, so I'm seeing if I can drop it here. There you go. So 050-114-9296. The number 2 is below the screen, scrolling below the screen. So you can WhatsApp that number if there is anything. Kwekudi. Okay. Then Kwekudi said, I would like a private tuition for ACCA. Yeah, you can send her on WhatsApp. My executive assistant uh will send you details on that, and send you my timing availability for my private classes. We have to look at my timing availability even before you enroll in the course or make any payment. However, it's 2,500 Ghana cedis per paper for a 2.5 hour per week session for me for 3 months. It means in total you're going to get uh, 12 sessions, 2.5 hours per session, and that is 2,500 Ghana cedis for a subject. So that is the basic rundown. But you send her on WhatsApp, my executive assistant will send you the details and my time availability. If it is favorable for you, then we can proceed and schedule for that. Pa Willie said, "Hello, Nhyira, long time." Uh, it depends. It's not long time. We've been releasing content on the channel. Okay, but it's been a while since I did live stream, though. I think you have a point, Pa Willie. Thank you for joining us on the stream. Alhaji Jallo said, "What are the factors that are relevant in determining annual depreciation? And kindly explain whether these factors are determined objectively or whether they are based on judgment." Depreciation is always based on judgment. Okay, it's always based on judgment, because the entity will decide that, okay, this is the asset we've bought, and based on the asset we've bought, we're going to use it for 10 years, or we will use it for 5 years. Or the entity can say, okay, even though we bought this asset and we said we will use it for 10 years, we are going to change it. So there are a number of factors that determines the depreciation. Number one, the expected useful life of the asset by the entity, or the expected obsolete years of the asset. Because of rapid changes in technology, maybe every 2 years, some assets become obsolete because of changes in technology. So if the item is technology driven like that, then we will consider how obsolete it will become and how many years will a new technology come to replace it. So that is a factor we consider. Then we can also look at the production capacity of the asset. How many units or how many outputs can we get from this product at the end of the day if it is really productive as an asset? So that is also another factor that the entity can consider. And like I said, all these are judgmental, based on judgment. It's not objective. There is no rule that says do this, do this. The entity will sit down and say, hey, this is we as an entity, this is us as an entity. Hence, if this is what the asset we've bought, this is our operations, then A, B, and C will be the guiding rule for us to determine the depreciation amount. So Alhaji Jalo, let me say that the depreciation factors is subjective to the entity, not an objective thing. It's based on judgment, and it is based on how long the entity expects to use the asset, the number of output the entity expects to get from the asset, issues about technology on the asset, issues about wear and tear on the asset due to usage, and even power capacity can influence how long an asset could be used at the end of the day. So these are some of the things that we can talk about. But like I said, it's going to be more subjective rather than objective, meaning it's based on judgment per the entity. I hope that makes sense. Let me know. My dream said, thanks much. I will do. Okay. Isa Abdul Hafiz said, hi, sir. Hello, Isa Abdul Hafiz. I see some of you guys joining. There's a Q&A session. Drop your questions in the comment section for me. Any question you have for me, whatever you're having challenge with, drop it in the comment section. I'm going to share my thought with you and provide you with some issue there. Isa Hafiz said, audit evidence, advanced audit and assurance. Okay. Audit evidence is a primary thing, because as we carry out audit procedures, analytical procedures, inquiry from management, inspection of documents, observation of processes and systems, recalculation and reperformance, these are the broad audit procedures. But then the audit procedures we perform depends on the assertion being tested, and the assertions being tested can be broadly categorized into three. We have assertions relating to the account balances at the end of the year, meaning the balances on the face of the statement of financial position. So if you are auditing a balance that is on the face of the statement of financial position, then the assessments you may be testing could be issue about existence. Is the thing there? Valuation, how much have we put on it? Classification, has it appropriately been classified? And completeness, does it include everything that is supposed to be included? Right and obligation, is the thing belonging to the entity, or if it is a liability, is the entity so the one supposed to pay? So when it comes to the account balances at the reporting date or at the end of the year, these are the assertions that we are going to be testing. Then we come to transactions and events. The transaction and events are the transactions and events that occurred during the accounting year. So for that, assertions that we go be the testing could be issues like cut off, whether all the transaction relates to just the current year under review, or there are transactions belonging to next year which has been recognized this year. And one of the key areas where cutoff is going to be apply is the issue about revenue recognition as per IFRS 15, because under revenue recognition, revenue should only be recognized when we have satisfied a performance obligation. But sometimes the entity can sign a contract during the end of the year, and they may include in the revenue that value or the revenue from the contract, even though they've not done the work. So cutoff will be one of the assertions we test for transactions and events. The second thing is going to be completeness. Does it include all the transactions? The third thing is going to be classification. The fourth thing is going to be the issue about its valuation as well is going to be looked at. Then we have disclosures as well there. Now, what am I building to you? I'm building to you to your question that we carry out audit procedures, AEIOU. But then what the procedures we carried out depends on the assertion being tested. Then, as you carry out the procedure based on that session, you gather audit evidence. And primarily, the audit evidence we obtain should be sufficient and appropriate. Sufficient simply means that the audit evidence should be enough to enable the auditor reach a reasonable conclusion so that we can issue an appropriate audit opinion. Okay? But then audit evidence should not just be enough. Audit evidence has to be what? Uh, Appropriate as well. So it is sufficient and appropriate. Appropriate simply means that the audit evidence must be relevant, and the audit evidence must be reliable. Now, the reliability of audit evidence depends on a number of factors. For instance, audit evidence obtained directly by the auditor is more reliable than evidence provided by the entity. Number two, documentary evidence is more reliable than oral evidence, meaning evidence that has been written and signed will be more reliable than evidence that has been spoken verbally at the end of the day. Then evidence provided by an expert or from an external expert source will be more reliable than evidence provided internally by the organization. So if you talk about audit evidence, that is what we are talking about. So you see that before I answered your question on audit evidence, I dropped you back two steps, which is audit procedure based on the assertion we are testing, then we can gather the audit evidence. So to determine whether the audit evidence is relevant, to determine whether the audit evidence is appropriate, you must ensure that you understand the assertion you are testing. Then you must ensure that you are using the appropriate procedure. That will help you to gather sufficient, appropriate audit evidence, which then enables you to issue a reliable audit opinion at the end of the day. Does that make sense? Let me know. That is for Isa Abdul Hafiz. Let me know if that makes sense for you. Vena Akon said hi. Hello. Let me know. Hi. Welcome to the live stream. Tahiru Nuhu said, DSA, I am having a doubt on doing ICAG because of protocols in Ghana. What kind of protocols, man? In Ghana, please, can you share your thoughts? Can you share your thoughts on getting ICAG, in getting a job in Ghana, or better, gathering the money for protocols? Ha! Oh my God. I don't know what you mean by protocols though, but What I would say is that you cannot substitute cost for anything protocol. Okay, because yes, protocol is everywhere. You cannot overemphasize that it's everywhere, but that doesn't mean you won't learn. Does that make sense? Because let's say you have a protocol, maybe your government is in power, or you know somebody who is powerful because his government is in power, and that person helps you to get a job. Okay, even though you don't have the certificate. If another government come and they are laying off people, they will lay you off, and there you are without any certificate. But if you have the certificate, you have proved your point, you've earned it. So yes, protocol is there to help you if you qualify. So I would say that pursue the course, become a chartered accountant all the way, and the protocol helps you to become more successful as soon as possible. And one way or the other, we all need protocols once in a while. So please don't use the money to pay for protocol. I wouldn't suggest that. I would rather say qualify and put yourself in the position and where, by the grace of God, a door can be open for you in that case. Then let me also say that, you see, doing the ICA course does not mean you should go work for somebody. Okay, I understand that. Oh, it's difficult to do your own business or start a business in Ghana or in this part of the world because of the way the environment is. But don't put your mind on it that you are going to school, you want to become a chartered accountant so that you will get a job. What if you don't get a job? There are people with MBAs who don't have a job, and they are there joining unemployment associations. One of the dumbest things people do in this part of the world and across the world, I don't get it. Why do you have an MBA and join unemployment association? What did you learn in school? What are you using your head for? So what I would say is that don't use the money to pay for any protocol if you don't have the qualification. Use the money to invest in yourself. The best investment you can make, Tahiru, is the investment in yourself. Okay? Is the investment in yourself. So pursue the ICAG, become a chartered accountant, be the best in your industry, and doors will open for you. That's what I'll tell you. That's what I'll tell you. Okay? So hands down, invest in yourself. Don't use the money for any protocol. Yeah. What if you finish and you don't get a job? If you don't get a job, start a company, right? There are a lot of companies out there who are looking for people to help them prepare their accounts. And the problem and the reason why many people are complaining in this country that there is no job is that they have an ideal job that they want. There was a time there was a job fair that the government organized, and I saw people talking to the news and speaking with a journalist, and the person was like, "Yo, I have first degree, and I'm looking for a job, and my minimum salary is 2,500. Anything below 2,500, I won't take." And I'm like, that is unwise. That's absurd. That's stupid. First degree, you're looking for 2,500. What is in your head? What are you bringing on the table? You think companies employ people because of certificates? No. What if you can get a small company where you learn a lot? Learn all the skills in the trade, and they will give you 1,000 Ghana cedis or 1,500 Ghana cedis, and that will cover your TNT, your food, and a little bit for your rent. How about that? That's great. Okay, that is great. So I will entreat you that, Tahiru, study. Don't go for protocol. Invest in yourself. Pray to God. Tahiru Nuhu, I think you are a Muslim. Believe in Allah. You don't believe in God. There are miracles happening every day. So go to do the ICA, hands down. Do the ICA. That is what I would say for you. No protocol. Do the ICA. When you do the ICA and you chatter, and an opportunity come and there is protocol, why not? You jump for it. By then you qualify, and then the protocol just whisks you so that you become successful as soon as possible. So that is what I would say there, Nuhu. Let me know if that makes sense for you. Kweku D said, I mean your personal one, not that one. Your rude receptionist manages. What do you mean by that? If you want to get to me, that is the contact you go through. So I don't know what you mean by rude receptionist. What did my Assistant do. I've never received that kind of words describing my executive assistant, Joycelyn. She's the best. I don't know what you are talking about though, but she's the best. She will never do anything that is rude. That one I can guarantee you. So you WhatsApp that line, there is no way you get to me without her. So you go through her that way. I don't think she's rude. I don't know what the heck went on, but I will speak with her about it. But I don't think she will do anything because I know who she is. She will never screw you up. Bongeka Charmaine said, watching from South Africa, can you do a session on preliminary engagement, accepting an audit, planning an audit? Oh my God. Bongega. This is a lot of things. So I'm struggling a bit with this. We will see. That's a whole session on audit. So I don't know if we can do that. We will see. We will see if we can do that, if it is possible for us to do that. Let's take a screenshot of this. Okay. We'll see if we can do that if it is possible. Or we will release some videos relating to the topic that will help you. Nuhu said, okay, with a thumbs up. Yeah, so Nuhu, that's okay. Vena said, please, about the disposal of subsidiary. Yes, Vena, what is about disposal of subsidiaries? What about disposal of subsidiary you want me to talk about? Give me some specifics and let me share my thought. Yadom Nana Ekia Konedu. Wow, I love the name. Yadom Nana Ekia Konedu. Good evening, sir. Please, how do we treat tax relief in the calculation of tax in accordance with IAS 12 and its effect on the financial statements? How do we treat tax relief in the calculation of tax in accordance with IAS 12 and its effect on the financial statements? Let me get a context of your question a little bit well. You mean the government gives a tax relief for the entity and how it is treated at the end of the day? Um, like you know already, so maybe let me punch in some numbers. I'm not getting the exact context well, but then let me use some assumptions and then let me know if that assumptions make sense for you in that case. So what you are saying here is that let's say government gives us a tax relief, and so we are supposed to pay a tax of maybe 25%, and then government says don't pay 25%, pay maybe 12% or 10%. The difference becomes a tax relief. Really, the issue about tax relief is that it is treated more or less like a grant rather at the end of the day. Now the effect is that what will happen then is that it is going to technically reduce how much tax that we are supposed to provide for the current year or charge for the current year at the end of the day. So let's say you have a tax relief of say 10,000 for the year, and then your tax provision for the year is 15,000. That means the relief reduces technically into what? 5,000 at the end of the day. But you don't come and deduct it directly. The tax relief is usually treated sometimes as a grant that we are receiving from the government in accordance with IAS 20. So it becomes more or less like a deferred income, so that the grant is credited, the tax is debited, and then the net effect is taken care of at the end of the day. That is one way it could be treated. Another way is the default way that I mentioned, that for instance your tax is 15,000 and government has given you a relief of 10,000. So then technically the tax due that you're going to be accounting for is going to be 5,000 at the end of the day. So the tax reduces, or the tax relief reduces the current tax liability, and it could be treated as a grant. The difference, that is a tax relief you are getting as a grant, because it's a grant you are getting from the government. Tax relief is a grant. That is a more appropriate way to treat it, to enhance faithful representation of the financial statement. But alternatively, the entity can use it to reduce the asset for the year under review, or the tax provision for the year under review. Nana Ikuya, let me know if what I said makes sense for you. Let me know. Then Bongega said, I also want a private session. I sent a message on WhatsApp, but no response. Really? There should be a response for all my messages because my assistant will reply to all of them. Let me see. Maybe she's offline. Definitely she will reply. So just send her on WhatsApp. Once you have the WhatsApp line, you can send her on WhatsApp and then details will be arranged. Our private class is 2,500 Ghana cedis. Maybe that will be somewhere around a little less than $400 or so in that case. And that gives you 12 sessions, 2.5 hour per session with me. So you send her on WhatsApp, definitely my assistant will attend to you in that case. I see some of you guys joining. Welcome. It's a Q&A session. Drop your question in the chat for me, and I'm going to see what we do. Rashid Mumuni said, please, will you be doing a video to discuss and analyze the pre-scene material for um, strategic case study for the April 16? Thank you. I will not be doing a video. I'll be having a session with my students during our executive revision masterclass to discuss the pre-scene with them, definitely. But I don't think we will do a video on that. We are thinking about it. If it is something we receive request on, we will have a free session for that to discuss the pre-scene. But now we've not made the decision on that yet, so I cannot say anything about that for now. But I'll be discussing that with my students here. Isa Hafiz said, thank you, Nhyira, for the explanation on the audit evidence. Okay, that's great that you get it. Sonny Kokecho Morake. Forgive me if I don't mention your name right, okay? Don't screw me up. Sir, please make a video on the way we tackle financial management. Okay, yeah. I don't know. I think we have already made a video on that, but it's not published yet. So my team is working on that. I think probably they are working on the editing, or maybe it's already prepared. So it will be up this week. Okay, so the key issues about financial management will be available on the channel pretty soon. Maybe this week, definitely. I'm hoping that they will make it available. Anita Equia Owusu is giving us a thumbs up. Okay, thank you, Anita. Oluwa. Hey, this name there, I can't even mention the name. Let me just end on Oluwa because the rest I can't mention. Forgive me, okay, Oluwa. Good evening, brother. How do we treat depreciation under IFRS 15 construction contract? IFRS 15 is revenue from contract with customers. It doesn't talk about depreciation there. So I don't understand your question. Depreciation is dealt with as per IAS 16. In IFRS 15, there is nothing on depreciation. Or you need to tell me something I don't know. So depreciation is dealt with under IAS 16. IFRS 15 is revenue from contract with customers, and you don't deal with anything depreciation there. Who said, thanks, sir. I have all the answers I wanted in my question. Thanks, Allah bless you. Amen. God bless you too. Good evening, brother. How do we treat? Okay, the same question I think I've already answered. Kokecho said, okay, thank you, sir. Always a pleasure. All right, so any other questions for me? Put it in the chat for me as we continue with our discussion. Like I said, this is a Q&A session, so I want to share my thought on any questions that you may be having here. Let me see. Bongeka, which number did you WhatsApp? I'm trying to go through the message here myself to see. I'm trying to see which number you WhatsApp. But like I said, whatever be the case, my assistant will handle it for you. So just send her a WhatsApp again. Definitely details will be sent to you. Okay, I think I just went through your chat here and I'm seeing your chat. Okay. So I'll notify her to look at that for you. Okay. All right. So, okay, I'm seeing another question coming up. Let's see. Werner said, please, how do we treat the disposal of subsidiaries in consolidated financial statements? Okay. You gotta be careful. That is a whole school on its own. So that's a whole school on its own. When I say a whole school, I mean like that is a whole study on its own. What do I mean by that? You see, disposal of subsidiary, you got to be careful what you are talking about. Okay, that is why I said it's a whole school on its own. Maybe I would have to do a session on that or whatever, but it's a whole school on its own. The reason is that there are 4 levels of disposal of subsidiary. Number one, number one is 100% disposal. Okay, so we dispose of the business. That's all. When we dispose of the business, in that case, any profit or loss from the disposal is recognized in the group retained earnings or recognized in the statement of consolidated profit or loss account for the entity. That is 100% disposal. Now, the way you calculate that profit or loss, there is a way you calculate it. There's a way you calculate it. Then there is a situation where the entity dispose of part of the subsidiary, but doesn't lose control. So maybe they have 80% ownership, but they sell 20%. So even though they've sold 20%, they still have control, okay, of 60%. There is a way we treat that also. That is just transfer. And so that one is treated usually in the group retained earnings. Then there is a third one where the entity sells the subsidiary but retain a percentage for significant influence. There is a way we treat that one also. Are you okay? Then there is a fourth one where we sell the subsidiary, but we retain part of the investment as an asset, an equity investment, and account for it as per IFRS 9 financial instruments. And there is a way that is also treated. So it's a whole school on its own. It's not something that I can just jump over and share my thought on. It's a whole discussion on its own that you have to understand. Maybe we will see one of these days. We will go through some of these changes in ownership for corporate reporting students exclusively on the stream to see if possible for us on that. So you can stay tuned if that is going to be coming up. Then you'll be able to go through. But like I said, there are 4 things, and it depends on what the question is stating and which of these 4 is in the question that will influence the way it will be treated in the financial statement. Does that make sense? So that is the issue there. So it's a whole discussion on its own, unfortunately, and we must look at that on its own. So let's see. Augustine said sales variance in MA. What about sales variance, to be specific? What about sales variance, to be specific? Because if you look at sales variance, it's broadly divided into 2. We have the sales price variance, where we are looking at the difference between the standard price and the actual price. So the actual quantity that we have sold, how much should we have sold it, and how much did we sell it? Okay, that is the sales price variance. And then we have the sales volume variance. The sales volume variance is the difference between the budgeted sales units and then the actual sales unit at the end of the day. But then the sales volume variance computation depends on whether the entity is using the marginal costing system or the absorption costing system. Does that make sense? And so we you have to know which system. If you're in the marginal costing system, then we multiply the difference by the standard contribution. If it is the absorption costing system, then we multiply the difference by the standard profits for the entity in that case. So that is the issue about that. But also, when it comes to the sales volume variance, where the entity is selling more than one product, then we're going to have the sales volume, the sales mix variance, and then the sales quantity volume variance. The sales mix variance and the sales quantity volume variance. So that is based on if the entity is selling more than one product at the end of the day, and that affects how the treatment is going to be made by the entity. Does that make sense? So that is the issue about that. Maybe give me some specifics on what you have on the sales variance, and I can share some thoughts with that as well. Vena said, what? Elbow cough. I don't know. What is that? Maybe it's an emoji she's putting up. I don't know. Olua said, how do you treat depreciation if PPE is used in contracts under IFRS 15? Oh, so if we use an asset for a contract, then the value of the asset shall be included in the cost of that particular thing that we are constructing at the end of the day. Okay. So it means that depreciation in that case will not be expense, but will be included in the initial cost of the contract. That is how we do the treatment. Let me know if that is what you were seeking clarification on. I see another question coming in. For Lenche, forgive me if I don't mention your name right, okay? I think this should be a South African name, I guess. Let me know. Good evening, sir. With regards to IFRS 16 leases, if the date on which the lease was entered into and the year end date is different, does that have an impact on your amortization table? I don't understand the question. Let's read it again. If, with regards to IFRS 16, if the date on which the lease was entered into and the financial year date is different, does that have an impact on your amortization table? I still don't get the context of your question, because definitely the date on which the lease is entered into is going to be different. But then the reporting date, you have to calculate, you have to find out how long to the reporting date. So for instance, if the lease is entered into on 1st July and the year ended of the company is 31st December, meaning your amortization schedule will be done on a maybe 6 months basis. You could do that on 6 months basis, or you could still be on yearly basis, scale down to 6 months basis. So I don't think it will influence. If you understand the way the amortization schedule works, then the dates we enter into the lease does not change anything. You just have to know how long from the day we enter into the lease to the year ended, and then whether you can charge the amortization for a full year or for just a period of time for the calculation that you're going to be doing. So maybe give me more context, then I can give you some idea there. But like I said, if you understand the amortization schedule well, the time we enter the lease and the year ended will always be different. Your concern is to know how long do we have from the time we enter the lease to the reporting date, and that will influence or have an impact on the way you do the calculation at the end of the day. Nana Equia Konedu said, thank you, sir. The tax relief was on PPE before the tax authority charged the capital allowance. Do we reduce the asset by the relief before applying the capital allowance percentage. Thank you, Nhyira. The tax relief was on PPE before the tax authority charged the capital allowance. Do we reduce the asset by the relief before applying the capital allowance percentage? Okay, so I think this is in reference to the question you asked earlier as well in that case. Like I mentioned, when you are dealing with, so it means here you are dealing with a tax base of the asset, and the entity has given you a tax relief because you bought the asset. Yeah, like I said, there are two ways this can be treated. The tax relief could be treated as a grant in accordance with IAS 12 so that you still maintain the way the deferred tax computation will be done, as you know already as per IAS 12. Or if it is appropriate, as per faithful representation, the tax relief could be deducted from the PPE figure. Then uh, we calculate the capital allowance so that we can get a tax base of the asset at the end of the day. But again, that is in the books of the tax authority. When you're dealing with tax base, you are in the books of the tax authority. But then if government gives you tax relief, you have to deal with it also in your books as an entity. That is why I'm saying that the best way of treating or doing the treatment is to look at it from the perspective of uh, as a grant in our books, so that that credit entry will reduce whatever tax that we are supposed to pay in relation to it. So I don't get the context of your scenario. Maybe there is a question you are looking at. Um, it could be sent to us on WhatsApp and I could look at it for you pretty well to see the context in which we are coming in, because determination of the tax base is from the perspective of the tax authority. And unless I get a context of the scenario you are dealing with, I will just give you the treatment as per generally accepted principle. Okay? As per the treatment. Because yes, there is a school of thought that will say that subtracting it from the cost of the PPA and applying the capital allowance percentage so that you get a tax base is correct. But okay, that tax relief that the company has received, how does the company treat it in its books? How do we treat it in our books? Does it mean we don't do anything with it in our books? No, there has to be something that will be done with it in our books. So the treatment will be based on a couple of contexts that I would have to confirm at the end of the day. Viva Ghana said, hello, what is the difference between equity instrument and debt instrument under financial instruments? You just said it. Equity means equity. Debt means debt. That's it. You just said it. Equity means equity. Debt means debt. Okay, but this is the thought you need to understand. When an entity issues uh, a convertible loan note, it is called a compound financial instrument. So, as per IFRS 9 financial instruments, it should be splitted between the debt component and then the equity component. So, when an entity issues a convertible loan note, it has both an equity instrument and then what? A um, a debt instrument. So, if you ask me the difference, that is it. Then, if an entity issues shares, only shares, that is a financial instrument, but that is an equity uh, instrument as well. And so we recognize it as part of our share capital because we don't have an obligation to repay the shares at the end of the day. Then, if an entity buys shares in a company, that is going to be treated as equity investment. And so, from the perspective of the entity buying, they will still call it as equity investment, only that this time around it is an asset to be included in their non current asset if it is held at fair value through other comprehensive income, or as current asset if it is held at fair value through P&L for the entity. So that is the issue about that. Let me know if that makes sense for you. Viva Ghana. Kofi Chebi Edu said, in factoring, what should the debtor balance be included in? What should the debtor's balance be included in your comparison of cost? I don't understand your statement. I think your question relates to financial management, factoring of debtors. If you're looking at factoring of debtors, you look at the factors cost, okay, then the interest on the advance that the factor is giving to you, that is going to be included as well at the end of the day. Then you look at the savings you will get from your administration, then the savings you will get in the reduction in the bad debt. So the debtors balance itself is not considered usually when we are dealing with factoring. Again, maybe if that doesn't make sense for you, give me context the question a little bit for me, then I could answer. But that is the idea. We don't really include the debtors balance when we are dealing with factoring. We look at how much the factor is charging us. If the factor is advancing some of the money to us at an interest, we look at the interest on that as well. Then we look at the administrative savings we are going to be having as an entity because we are not managing the debtors again. Then we look at the reduction in the bad debt. That is also a savings we're going to be having at the end of the day. So really the debtors balance itself we may not be considered when we are dealing with factoring. Johnny Stacker said, what's better, Ghana? What's better? Ghana jollof or night? Have not eaten Nigeria jollof before. So I can only testify to you. I don't know why that question is coming in though, but I've not eaten Nigeria jollof before. I've only eaten Ghana jollof. So Ghana jollof is better. Dr. Jesus El Shaddai. Hi, Nhyira. Please do more question answer tutorial. Start with IAS 8 and also employee benefits. Okay. Thank you. What is that? I don't know what the heck is that. Alhaji Jallo said, please, can you explain IAC revenue recognition? What is ASC 600? I may have to look at it and then share my thought on that. Definitely not today. Okay. I'll look at it and definitely not today. Kofi Chebi said, it makes perfect sense. That's the answer I was looking for. Okay. All right. That's great. That hit. Accounting standard codification. Okay. Like I said, I'm in my brain. I don't want to. I've not read about the ASC 600 how revenue is recognized, but then in my brain, the way we recognize revenue is, I think it will be in line with IFRS 15, but I will look at it later on and then share my thought on it because I've not read what ASC exclusively mentioned. So I will not be able to share my thought on that. And I don't want to say anything that is wrong. I mean, this is a big platform. I don't want to say anything that will be wrong at the end of the day. I want to make sure that I'm perfect and I know what I'm saying. So I will check it up and then later on talk to you about it. But like I said, in my brain, generally, it's assumed that revenue will only be recognized when we have fulfilled the work, when we have transferred control in the asset at the end of the day. But I'll look at it, and then if we will be having another session tomorrow, God willing, I will share my thought on that for you. Yeah, Dom Nana Ikuya Konedu said, thank you, sir. I'm grateful. Okay. Info said, thank you, sir. Now I understand why in the calculation they multiply by 6 over 12. Oh, okay. Okay. Yeah. So, like I was saying, if it is half a year, then you will charge your finance cost for half a year. Or if it is 8 months, you will charge it in that regard. Kofi Chebi said, hey, do I still have time? So then, in that case, will bad debt be a cost to consider if the factor takes control of it? You know, when the factor comes in, our bad debt is likely to reduce. So reduction in the bad debt is a savings to us. Does that make sense? It becomes a savings to us. So if, for instance, we were managing our self and bad debt was say $20,000, and now when the factor comes in, bad debt is going to be $2,000. That means we've saved $18,000, and that is a cost savings to us in that case, and that will be taken into consideration there. Kofi, let me know if that makes sense. Sinclair Tutor said, "Evening, sir. Missed the start." Oh, okay. It's a Q&A session that I'm taking though in that case. Okay. Any other questions for me? I'll be concluding around here today. It appears that we could really deal with uh, a lot of issues during these Q&A sessions. So possibly tomorrow I'm going to be coming your way again with another Q&A session like this. So prepare yourself up. Anything that you are dealing with that you have issues with, maybe tomorrow I'll grab my iPad and then I will explain some of the things that was raised here today, like disposal of subsidiary. Maybe I'll share my thought on that for that what came up on that. Then any other thing. So we could do another session tomorrow, still on the Q&A, to see how far we can go as I help you in your revision session. Umfo said, lol, and yes. Umfo is a South African name. Oh, okay. That's okay. Because I just realized that possibly it could be highly South African. Okay, so that's it about that. Right. So as you revise for your exams, a few things I want you to just take into consideration. I made mention of the fact that I'll be sharing some strategies with you, but your questions were more, and that is pretty important to me as well at the end of the day. So tomorrow we're going to have another session just like this. So come on with specific questions. Okay, this is a Q&A session. So if the questions are specific, then I can give you specific answers like that, and that will help us to actually answer the question and provide you with a better understanding at the end of the day. So I'll be coming your way tomorrow as well. Gloria Chencha, and then Na Yusuf, and then Ato Tomford. Thank you for the likes and thumbs up on Facebook. And then some people also on YouTube. Thank you guys for the thumbs up on the video. It really helps us a lot to reach a lot of students there. So I'll be concluding around here today. And God willing, tomorrow I'll be coming your way, same time, 12. Did I say 12? 4:30 p.m. as we continue with our discussion. So get your questions ready for me next week, and then let's see how I can provide you with some specific answers as you do your revision. Thank you very much, all of you guys, for the questions. Really love the engagement that we had. And tomorrow we will continue with that regard. Be specific with your questions. Have something specific for me, and I can help you better by providing you with some answers in that case. So thank you, and I'll catch you same time tomorrow as we continue with our discussion. Remember that I have shared the key topics to focus on to pass advanced audit and assurance, advanced taxation, principles of taxation, public sector accounting and finance, financial reporting. I have shared key topics and how you are supposed to answer the questions on these topics. You can check the how-to playlist on the channel, and you'll be able to watch those topics if they relate those subjects if they relate to the subject you are preparing for in the examination, so that I can assist you better to pass the examination. So that's it about that. And that'll be all for today. God willing, tomorrow we will continue with our discussion. Till we meet again tomorrow, stay safe and stay blessed. Bye bye.